I want you to imagine, for a moment, that you actually invested in 1998. The year is 1998, and the world is literally going crazy for the internet. New companies are popping up out of nowhere, and every investor you know believes they have found the next big thing. So, you take all your money and invest it in a few tech stocks simply because they have a cool, catchy .com name. Because that was the trend. For a couple of years, you think you're a genius monster. You're multiplying your money. Everything is great. Until the year 2000. It was too exciting. An unprecedented drop occurred in the US markets. Traders and investors are in shock. Oh my God. Even Bill Gates, the world's richest tech guy, lost $1.8 billion that single week. What? Of course, this bubble was going to burst. The Nasdaq fell nearly 80%, and only 48% of those .com companies managed to survive. I watched my friends lose their millions right in front of me. Even my investments took a hit, although I had anticipated a 50% collapse in my predictions. And you know what the funny and crazy thing was? The internet really was the next big thing. But even back then, overconfidence and hype created one of the biggest bubbles in history. So, why am I telling you this whole story? Because we are flying to the present day, and I can't shake off that feeling. I feel the same energy again. But this time, the source of the energy and power is not the internet. It is artificial intelligence, AI. People are calling it a once-in-a-lifetime opportunity. And maybe they are right. Or perhaps the same story is repeating itself from beginning to end. History may not repeat itself, but it certainly rhymes. And every generation thinks they are entering a new era. But John Templeton famously warned, the four most expensive words in investing are, "This time is different." So, is this time really different? So before we panic, let's pause and take a breath. We need to look at the three hidden forces fueling this potential bubble, why they matter, and most importantly, how you and I can turn all this chaos and crisis into an opportunity. 1. The Magnificent Seven, the AI arms race. Right now, the fate of the entire stock market and your portfolio is being decided by just 7 companies. We call them the Magnificent Seven, and sometimes the Savage Seven: Amazon, Microsoft, Alphabet, Google, Meta, Apple, Tesla, and Nvidia. They make up almost 36% of the S&P 500, and they are in an arms race to dominate artificial intelligence. So, even if you only own a single index fund share of the S&P 500, you are already heavily betting on these companies. Your future returns will depend on how this race ends. Why? Because every dollar these companies invest creates ripples across the entire market, from chip manufacturers to energy companies. And you will understand why when you see how many billions of dollars they will pour into AI this year. Tesla plans to spend over $5 billion on autonomous driving, and xAI, Elon Musk's new venture. Apple, $10.7 billion to make Siri smarter and more useful. Honestly, that money probably won't even be enough. Meta, $60 billion on data centers and the metaverse. Yes, still. Google, $75 billion to rebuild and restructure the internet with AI. Microsoft, funding a massive $80 billion to OpenAI and supercomputers. Amazon, a wild $100 billion on AWS to own the infrastructure everyone relies on. That is a total of $330 billion in a single year. And this is just what we know. To put this into perspective, this is more than the entire GDP of countries like Finland or Portugal. All this money is being spent to build the future. Some are even calling this the fourth industrial revolution. And yes, I get it. It sounds incredibly exciting. Because this truly is a revolution. However, here is the catch. All this spending seems to be what is propping up the economy right now. Without it, the US could already be in a mild recession. So, the question is, how long can it last? It does not look like it will end anytime soon. Global AI spending is expected to reach at least $500 billion by 2026. Furthermore, spending on the power and resources required for electricity demand is estimated to hit $3 trillion annually by 2030. This shows how much companies want to win the AI arms race. We can see why. The IMF estimates that about 60% of jobs in the developed world are exposed to AI, meaning they can be transformed or replaced by automation. The first to crack this technology will be rewarded with enormous power. Even Mark Zuckerberg said that Meta misspending $200 billion would still be worth it, because if they move too slowly, they will be left out of the competition. But this race is no longer just between companies. It is between nations. The US and China view AI as the key to global dominance, and both are burning billions to possess this power. For us, regular investors, this could result in two different ways. If AI delivers on its promise, the next decade could be like the internet boom. But if profits do not come fast enough, the same stocks that are inflating your portfolio today could drag it down tomorrow. So, where is all this money coming from? This brings us to 2. The AI money machine. When I first saw this, I said it was unbelievable. It is called the AI money machine, and this is the main reason I am starting to worry about the state of the AI sector. Let's simplify this complex scheme. There are giant companies like Intel, AMD, and NVIDIA that design the chips. There are the AI companies like OpenAI, xAI, and smaller players who buy these chips. And there are data centers like Oracle and CoreWeave. They also get the chips and then rent computing power to the AI companies. They are the intermediary companies. At first glance, nothing seems unusual. But when you look at how they are working together, red flags start flying high. It all started when Microsoft funded OpenAI with $58 billion. OpenAI then paid that money back to Microsoft to use their data centers. Microsoft used that money to buy NVIDIA chips. And finally, NVIDIA gave that money back to OpenAI as an investment, because it saw the power. This situation allows each company to record this flow as revenue, which naturally drives their stock prices up. This is a bit like if I paid a friend $1,000 to dig a hole, and then they paid me $1,000 to fill that hole back up. Now we both have $1,000 in revenue. If we were valued like OpenAI, which is currently trading at more than 40 times its revenue, our hole digging and filling business would be valued at over $40,000. Obviously, I am simplifying this for you to understand. These companies are not circulating the exact same money continuously. However, the idea remains the same, and things get even crazier. OpenAI announced a $300 billion deal with Oracle. Oracle then said it would spend tens of billions of dollars on NVIDIA chips. Then NVIDIA agreed to invest up to $100 billion in OpenAI. But only if OpenAI buys more chips. And it will. NVIDIA is the undisputed winner here. Its stock price has increased by 1,600% since ChatGPT was launched. They are selling their chips to everyone: Microsoft, Meta, Google, Amazon, OpenAI, and Oracle. Then, they are investing in the very same companies that are buying their product. This is like paying your customers to buy your product, and this can artificially increase the demand for their chips. It is a fantastic strategy. Can you see how complicated this is getting? Let me simplify it one last time. NVIDIA is selling the shovels. Oracle is providing the land. OpenAI is digging the mine. And they are all helping each other to draw people into the mine. But nobody has found the gold yet. So, OpenAI is currently valued at $500 billion, yet it generates roughly $12 billion in revenue per month and is losing money every month. This is the real problem I see. AI services are not generating enough profit yet, because they are not widespread enough yet. So, will these AI companies ever be able to generate the kind of profit that would justify their stock prices? Absolutely. They still have huge leverage they can pull. Over 700 million people use ChatGPT every week. That is a massive audience, and more importantly, a colossal amount of data about all of us. Just imagine what will happen when Sam Altman allows ads and lets companies use ChatGPT to recommend their products directly within our conversations. It could be something we have never seen before. They are everywhere. Furthermore, these AI companies are building systems that aim to reduce the cost of human labor. They are betting that once institutions become reliant on AI, they will have no choice but to keep paying, no matter the cost. And that is when the AI companies can skyrocket the prices and finally cash in. The stocks will fly. So, there is no doubt these companies are valuable. But most of that value is still tied to one thing: the belief that the pace of progress will continue to accelerate. And that leads us to 3. The data wall. Artificial intelligence has been developing at a dizzying pace for the last few years. I mean, we went from an AI video that looked like this to this. It's funny that Will Smith eating spaghetti has become one of our ways to judge AI development. The stock market is heavily relying on this rapid rate of development continuing. However, we are very close to hitting something called the data wall. For years, AI has been consuming every bit of public data available. By 2027, it is expected to have consumed almost all human-generated online content. This is like climbing a ladder in the game of snakes and ladders. Everyone assumes the ladders will continue, but we are running out of data to climb. So, instead, we might have to start moving square by square. If AI companies do not figure out a way to get past the data wall, we could see progress slow down, expectations crash, and the bubble that many investors are relying on finally burst. So, is passing the data wall achievable? Potentially. Think about it. Humans do not have this data limit problem because we do not just learn by being fed data. We learn by interacting with the world. My perspective comes from my experience, which AI cannot simulate. Because it is not artificial, it is real. So, scaling past the data wall is possible, but it is not just a problem of more data. It is a problem of different data. But look, I am not a scientist. Let's get back to investing and the stock market. This leads us to the conclusion: the best investment strategy. I started this video by comparing what is happening now to the dot-com bubble of the late 1990s. So, is it exactly the same? No, it is not exactly the same. The fundamental difference is that these AI companies have real utility and a much clearer path to profitability than most of the dot-com ventures. They are in a much better situation than companies that got crazy valuations just because of cool names. So, does that mean it is not a bubble? Honestly, I still think it is a bubble, but a bubble that will not burst. All the signs are there: overvaluation, artificial revenue streams, geopolitical mania, and scaling limits. However, there is no way to tell which stage we are at. This could be the beginning of a decade of crazy investing, or it could be closer to the end than we realize. An artificial end. So, what is the best thing you can do with your money? This is not financial advice, by the way. But if it were me, I would focus on the following. 1. Keep investing. Don't stop. Automatically. If we are at the beginning of the bubble, the prices we see now might look like a steal in a few years. That is why it is crucial to set up an automated investment that leaves your account every month and goes into a broad, low-cost index fund. This is what I did during the dot-com bubble. And while my investments took a hit when it burst, I do not regret anything. Historically, as it always has, the market recovered over time. And it will do so again. The real secret is to not panic when your portfolio drops. As long as you are invested in an index fund, continuing to invest during a crash can be the best thing you ever do. That is how I ended up making millions from the dot-com crash. Stay calm and watch. But to do this, you must make sure you are not in debt or over-leveraged. That is exactly why my friends lost their millions, and I could keep investing. You keep going and watching while everyone else is losing. 2. Focus on increasing your income. Your income is the fuel you use to grow your wealth. If you can increase your income by getting a promotion or starting a side hustle, this will supercharge your returns, especially if you can do it while the stock market is down, because that is when you will catch bargain opportunities. 3. Diversify. 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 Putting all your money into a single type of investment can be the end of you. The key to surviving market bubbles is diversification. This means spreading your money across different asset classes. My portfolio includes stocks, bonds, precious metals like gold, real estate, and even cryptocurrency. It is also worth considering dividend-paying stocks, as they perform well during market downturns, because they generate passive income even when prices are low. As the proverb goes, little strokes fell great oaks. Just remember this. This bubble bursting will not be the end of the world. If you understand situations like these, you won't be the one panicking. You will be the one seizing opportunities while everyone else is running away. Don't panic. Don't be afraid. Trust the process. What do you think about this bubble? Do you think it will burst? Or will it keep growing without ever bursting? Let me know in the comments. And don't forget to subscribe for more finance expertise and advice.